Oh, Cayman moon,
The voice of the Cayman Islands, Radio Cayman.
shining down from above.
We love our listeners.
Radio Cayman in the Cayman Islands.
Live from Radio Cayman Studio, this is
Money Sense, bringing an informed financial perspective to the Cayman community.
A very good morning and warm welcome once again to Money Sense. I'm Simon Caudry and I'm joined this morning by my co-host Adam Newman. Neither of us are actually in the studio this morning. Adam, can you hear me okay?
I can. Good morning.
Good morning. Well, as I was saying, neither of us are actually in the studio this morning because of the lockdown. So apologies up front if things seem a little different or if our voices seem a little unusual. We live in different times and we operate in different ways, and we will get through this, obviously. Anyway, good morning, Adam. Thank you ever so much for joining me. I trust you have locked up all your stray chickens, barking dogs, screaming children, and such like while we air live from our respective homes. I'm hoping for the best from my location.
Absolutely. All quiet. All quiet on the Western Front here.
Fabulous. Now then, what can I say about today's show? In essence, it's probably fair to say that a lot of people have watched probably too much TV in the past few weeks, and at some point felt a little scared. Scared for their actual health, scared for their well-being, or scared for their financial health. We can't do much about the first two, but we can hopefully try and address the latter. One thing I would say to a lot of people is just turn off the TV. Most of what you hear, you don't need to hear. You only need to watch the same thing once. You don't need to watch the same thing 15 times during the day and scare the bejesus out of yourself. It's not a bad thing to do to watch less of this inflammatory stuff. So that's the first thing I'd say. The second is there's some psychology involved when you look at TV, particularly in financial markets. When things are going well, the screen turns green. When things are going very badly, the screen goes red and starts flashing repeatedly. That's a lot more off-putting than a green screen. And it's designed that way to make people nervous and to build a sense of fear into them. Also, bear in mind that most people should be investing for the long term, 5, 10, 15 or longer years, that is. The virus won't be around for that long without treatments or without cures. And so what is happening now will be mostly an irrelevance from a financial perspective in 15 years' time. And if you invest now with that long-term perspective, you will have financial prosperity. Now, the purpose of today's show is to try and analyze how we get through the current situation and what the current situation means. And that's where I'm going to turn and rely on the wisdom and knowledge of my co-host, Adam Newman. Adam, there are many angles this conversation could take, but let's first, if I may, ask about safe havens. What are safe havens? Where are they? And how do we identify them in this environment? And perhaps as importantly, are they the same as they have always been, or are they different because of the environment we find ourselves in?
Great question, Simon. This crisis was, I guess, sort of more, at least initially, more akin to what we saw in 2008. And when we sort of talk about safe havens, we're looking for things that are less correlated or sort of, dare I say, uncorrelated with other asset classes, so that as things fall or move in one direction, the other assets don't get impacted. But what we saw with this, the sheer speed of fall, and I think we discussed this last time round, the sheer speed of the fall in markets, and then actually correlations, the way assets moved together, almost went to one, which means that everything moved very quickly together, and everything fell with the exception of US Treasuries and the US dollar. So even traditional assets, traditional safe haven assets, which people refer to as, often the precious metals, gold and silver, they also fell equally hard. And we also saw cryptocurrencies as well, which, people certainly felt in the crypto world that perhaps Bitcoin would act as a safe haven. It also fell sharply. So this was more around a liquidity crisis and things. Therefore, people were liquidating assets, selling assets just to effectively meet cash flow payments. But as the dust has settled, we've seen, some of those, the correlations have moved away from one, and we've seen a strong outperformance of things like precious metals again, and even cryptocurrencies have done well since then. So actually, when I think about sort of safe havens, it's really to think about things that would have a low correlation assets to other assets. But going forward, I think in the very short term, things can be dislocated and move as you wouldn't expect. But going forward, I would expect more traditional safe haven assets of precious metals to perform well. And I think this is certainly somewhere where where listeners should park at least some of their money. Precious metals, they are, they act as well in a deflationary or an inflationary environment. And one of the real sort of core tenets of why I think people should own some precious metals would be, if you look at the actions of many central banks around the world, they have been accumulating gold and silver in the last few years. And therefore, sort of betting against that would seem odd. Actually going with the trend seems to make sense. But I think also when people think about safe havens, it's important to think about what that world may look like, 1 to 15 years from now. And those assets are going to do well. So, I know you hear me talk about this a lot, Simon. I actually think cryptocurrency should also act as a safe haven in future, because it is part of the future we're heading towards. We're looking around the world, and there are many central banks who wish to issue digital currency. This is a trend we're going to see for some time.
You're raising that proverbial red rag to an ignorant bull here, is in terms of crypto assets, which I will come to. But one thing you said there, which I'd like to dwell on a little bit more detail, is it seemed to me as though you were saying, when the panic started with respect to what this virus and what the impact meant, that markets behaved in one way. Basically, everyone panicked about everything and got out of anything they could, not necessarily because they wanted to, but in some cases because they owned something that went down. Their counterparty said you need to put up more collateral because this asset's gone down so much, and that forced them to sell the stuff that was actually quite good. And in other words, everything went down over a very short period of time together. But now we're sort of in a dust settled environment, not to say that anywhere near close to having solved with the situation that we're in, or we're even past the worst economically of the situation we're in. And I would strongly argue that we're nowhere near past the worst economically of where we are. But now that the dust has settled, from a panic perspective, people are able to make investment decisions. And when I say people, markets generally are making investment decisions on a more fundamental type of basis, and therefore it's much more easy to make assessments as to safe havens versus not safe havens, because there is that distinction going on. Is that a fair way of interpreting something what you were saying there?
Absolutely. And what we've now seen since the crisis and the real sort of pinnacle of the crisis is we've now witnessed what central banks and governments are going to do to try and fight the crisis. So that makes everything look a bit clearer in terms of how you think about asset allocation going forward. And by that, I mean, we have already, if you look around the world, responded with huge monetary stimulation. I think more than 6 trillion, if you look at what's coming out of the US, combined with other countries. This is unprecedented. We didn't see anything near this sort of stimulus back in 2008. And it's clear that governments are going to fight this, and central banks, by initially throwing as much money as they can at markets to ensure that they behave correctly and don't effectively freeze up and collapse. And I think the next wave, which we're starting to see, and again, this is, plays into the sort of safe havens and how we should think about things, is beyond monetary stimulus, we're starting to see fiscal stimulus as a result. Governments spending money, whether that's on supporting lower incomes, on building out infrastructure, but it's really given us a view of what the sort of playbook for the next few years is going to be like. And as you said, Simon, we are not anywhere nearly through the economic implications. This is, and we can talk about it later, this is probably going to last certainly more than a year to really play out. But governments are not going to pull back. They are going to keep trying to spend their way out of this to try and stimulate the economy and get things moving again.
Now, you mentioned a big number there, 6 trillion. I don't actually know how many zeros that has after it. It's got more than my bank account certainly has it after it. But 6 trillion is a big number in anyone's book. And if I were to cast my mind back just a couple of years to when I was at university, I say that tongue in cheek, obviously, if I was to cast my mind back, studying economics there, one of the principal fundamental facets of economics that one generally studies, everyone seems to have to write the essay, inflation is always and everywhere, a monetary phenomenon, discuss. Now, Milton Friedman was the author of that quote, if I'm not mistaken, and he would, I would suspect, have been abhorred by the fact that $6 trillion or 6 trillion of whatever currency is being generated and injected into an economy, because that, from a traditional classical monetary school of thought, would imply that there's going to be unprecedented levels of inflation, because inflation is a direct result, according to his theory, of monetary policy. Then we have Emil, who has been, and I'm not necessarily ranking Emil up there with Milton Friedman just yet, Emil being one of our co-hosts, but Emil has made the point on a number of occasions during our show that that's great, but there's been this breakdown in the transmission mechanism of money. So you can throw 6 billion into an economy, but if no one spends 6 trillion, it makes no difference. Will this time be different? Where are we? Should on the one hand, you've got basically the worst economic downturn since the Great Depression expected. That's not a forecast. That's an expectation now. And on the other hand, you've got $6 trillion of liquidity, of money being thrown into the system. Now, Great Depression equals things falling, prices falling, depression. That's what a depression means. On the other hand, monetary expansion implies inflation. Those are fundamentally opposed concepts. So which one is more likely to occur?
So that is a great question. I think we should think inflation can come from different places. And I am more in the camp believing that we are moving from a deflationary environment to an inflationary one. And I'll explain why. We've had 10 years or more of very loose monetary policy, which has totally failed to generate any sort of inflation. Inflation has been moribund for the last, let's say, 10 years because there just isn't the demand. The end demand from consumers. Many people have sort of, effectively spent less than they would ordinarily because we've had this sort of strange overhang on the markets. Where we've effectively been in almost emergency measures. Economic measures for the last 10 years. So people haven't been so inclined to spend. And so demand has been massively dampened. And what we've seen in terms of companies, rather than the companies spend in productive ways by, investing in the business and new markets, they've tended to, particularly in the United States, have reinvested that money through effectively share buybacks, which again does little to generate demand. What I think is different, and so initially I'd say, spending trillions, is it going to get to the right pocket? Probably not. Is the person who's just lost their business or their job and they receive a check from the US government of $1,200, which the government have just, announced, are they about to go and spend it on consumer goods? Unlikely.
Well, they can't, first of all, can they? They can't for at least a couple of weeks. They can't get out of their house in most cases.
Exactly. And even when they do, I think, and this is a conversation I've had with various people, I don't think that demand is coming back very quickly. Yes, there's a certain amount of pent-up demand that, when lockdowns get lifted, we're going to probably want to go and maybe to a restaurant or, to go out, maybe to the cinema, maybe, but I think we're going to be pretty cautious about that. What I think one of the unintended consequences of all of this, and where I see inflation potentially rearing its ugly head, is in the short term, we have broken supply chains. And I mean that for pharmaceutical goods, food, soft commodities. By that, we're no longer free to just source materials and goods from anywhere we like in the world, which we have done, through this process of globalization in the last, 10, 20 years, because of port closures, because of lack of labor, because people can't get out of their houses. We now can't get goods in the right places. I think the US, something like imports 80% of their active ingredients for farmers from China. A lot of that stuff's not happening. That means we're effectively pinching supply, and demand has come off, but probably not nearly as dramatically as demand for some of these goods, and particularly food. People still require the same amount of food, and actually people have been spending, arguably spending more money or more greater proportion of money on food. So I think we are going to go through a period where we get this commodity-driven inflation. And the interesting thing with commodities, and I've spoken about it before on this program, is we've had 10 or more years of a total lack of investment in supply in commodities because prices have been so low. We're still at sort of decade lows for many commodities. So we've got a short-term phenomenon where supply is being pinched, and a longer-term impact where we just haven't invested. I think this contributes to a sort of exogenous shock in terms of food and commodity inflation, which is something that is really hard for central banks to deal with it, because it's not a consumer demand thing. You can't just put up interest rates in the hope of dampening down inflation, because that's not where the inflation is coming from. Meanwhile, we've got huge amounts of debt, and raising interest rates is pretty problematic anyway. So I'm in the camp of believing we are moving from a deflationary environment, despite not believing that demand is going to be lacking for some time, into an inflationary one driven more by commodities.
But you could combine both of those analysis, what you're saying there, deflationary and inflationary, thinking that through. You could actually have both simultaneously in some respects, because you could have the luxury discretionary sector, cruise ships, travel, restaurants, as you alluded to, where you could actually see huge price competition because of a complete lack of demand, or a relative lack of demand, perhaps. So demand, if it's 10% less for an airline travel than it was last year, that's decimating for the finances of the airline industry, as it would be for the cruise ship because of the high fixed costs. But equally, and so you could see quite a lot of price competition in spaces like that, in spaces in technology, in spaces like clothing, because people just don't need that sort of stuff when they're suffering from a lack of basic earnings power, the ability to actually earn anything because they don't have a job. But on the other hand, the stuff that's an actual staple, and it's part of the consumer staples sector, and it's called that for a good reason, that you could actually see price pressure precisely because of this supply chain, the breakdown that you're talking about, the disruption that it's causing. We do have enough food and everything else on our shelves, and that there's no reason for us to expect that to change, but people may be forced to substitute one thing for another. There's talk in the US about one of the largest pork suppliers in the US having some problems currently. So people may, if they were planning to have pork for dinner, may end up having to have chicken for a couple of weeks while those sorts of things resolve themselves, and the price signal will adjust accordingly in order to incentivize people to fix that problem. So I guess my suspicion is you might actually have both in some quirky shape or form.
I think you will, and if we think about how inflation is calculated, it's difficult to see a big pickup in inflation anytime soon, because the components that go into inflation in terms of rent and prices of certain goods means we're naturally we're going to see a period of deflation. But as we alongside what I'm talking about, maybe potentially food inflation starting to come through, but what it means is maybe 6 to 12 months out, you may have an economy that's trying to heal, and at a time when food inflation is already running high, and then you start to get into a period of quite dramatic pickup in inflation. So, in short, I do agree with you.
Well, the other area that links to this is slightly the longer term consequences, where there are going to be issues. So you've talked about the commodity space, and we can perhaps spend a moment discussing how to gain exposure to that, or what types of commodities might be important to have exposure to. But the other angle is the other industries that might be affected. Now, it seems unambiguous to me, but then I've never gone on a cruise, never intend to really, that the cruising industry has close to no hope of survival for the short term. Whether people have short enough memories or can be persuaded for basically zero cost cruising in the future is a different question. But things like real estate, commercial real estate, people in offices, we're all, like it or not, we're all working from home, and most of us are relatively productive, and perhaps we'd all prefer to be back in the office at least once or twice a week, but perhaps there may be a change that people spend more time at home, and what does that mean for the price of office space? What does that mean for the price of other assets? So perhaps give us a perspective on where to go, where specifically in commodities that might be important to look at, and then also your view on some of those other longer term trends.
I mean, in commodities, I'm a big believer in the whole of the soft commodity space, i.e., sort of the foods, the wheat, the corn, the soy, the coffee, cocoa. So there again, this is the argument is we've had years of structural underinvestment in supply, and I think that that is coming to an end, as in the supply is going to struggle to meet the demand. The demand for feeding the world has only gone up. Part of the reason that we've had lower prices is technology has improved. So actually, the farming and harvesting of goods is cheaper. And ultimately, we do need to feed the world. We haven't had enough investment. So there are some exchange-traded vehicles, exchange-traded funds where you can effectively buy a basket of commodities. I would suggest that that's the most appropriate way for most people to get exposure. I also think there's interesting opportunities potentially in places like copper and some more industrial metals, because as I alluded to earlier, I think we are starting to see and will see a lot more of fiscal spending. Governments will start to actually spend on infrastructure, stuff that's potentially been underinvested, particularly in the US, bridges, roads, etc. That really requires some investment, and that's a far more productive use than potentially bailing out certain companies. So I think we're going to start to see that investment in things like 5G networks. As anyone who's working from home at the moment knows, the mobile phone and internet networks are really not fit for purpose when we've suddenly been had all of this extra demand. As people are playing on, kids are playing on iPads and parents are both trying to work from home. So I think that will see a big rollout of that, and there are industrial commodities and associated with that which should see a pickup in demand. So overall, and just the backdrop of this is most commodities are at multi-decade lows versus the US versus equity markets. Effectively, they're undervalued versus equity markets. I think we're going into a structural place where they outperform equity markets, on a relative basis for the next few years at least. So I think that's a great place. And then just touching on what you talked about, some more maybe sort of enduring changes as a result of this. I'm a believer that we won't just go back to normal, and it will take a while for the economy to heal, but there will be some industries that get hit very hard and potentially never really recover to the levels we saw before. So travel and all the associated businesses, be it cruise ships, be it airline travel, be it hotels, I think it's going to be hard to get back to those sorts of levels. I think, airline travels are greatly supported by business travel. I think if you're a business traveller, perhaps you used to go travelling, 5 times a year. Perhaps you realise through the use of companies like Zoom that you can maybe only travel 2 or 3 times a year. But that's quite a big hit to demand at a time where airline companies were struggling to make any money. Commercial real estate, although every parent probably right now who's working from home is desperate to get back to an office, I think they will realise that working from home and having a slightly better work-life balance is positive, and maybe you don't go to the office 20% of the time, or 30 or 40% of the time.
Yeah.
But you imagine
so 4-day weeks in the office, and then one day a week to work from home, see a little bit more of the family, assuming after this you still want to see them, and spread your time slightly differently, and that gives companies also the opportunity to better use the space they have and perhaps not expand or perhaps downsize the amount of physical infrastructure in terms of space that they need, right?
There's that, and I think the other potential thing we might see is that companies will realise they don't, or certainly prefer not necessarily to be right in the centre in a busy sort of metropolis, and may prefer to move slightly further away as well, through lowering rents. If your office space is too big and you need to, now is the time to renegotiate your lease, you may choose that actually it's better to be a bit further away from the city centre. So, for someone who's from London, and always amazed as I go through London the amount of developments, I think this is a real negative for commercial real estate in those sort of big cities. So I think that's going to be an enduring change that we see. So asset allocations and where we invest in the future, I think will change materially.
Interesting, because real estate particularly has been something that has been a strong diversifier for a lot of portfolios of pension funds, institutional investors over the years, and so that's going to have a real impact for some of those big players. Now, we've got only a few minutes left in the show, and one of the things I wanted to spend a bit of time on is trying to learn lessons from other countries and see how they can be applied to Cayman. And one of the things most countries are doing is bailouts. Now, I'm not suggesting Cayman has the capacity to do bailouts, but from a perspective of what impact do they have on the economy, we alluded to this before. Do you think bailouts, putting cash in the hands of people, is the best solution, or is there a better solution to try and get economies back on their feet?
Well, if we look, and it's often easy to be US-centric, given it's the sort of biggest economy in the world. So in the case of the US, of the 6 trillion, and maybe I'll get the numbers slightly off, but of the 6 trillion, only about 450 billion of that is being allocated directly to sort of be in the hands of individuals through paying this $1,200 paycheck, which is great, but that means the vast majority is going to corporations. And the worry with bailouts is there are certain industries that may require some form of bailout, but there are certain industries who may, and I'll speak specifically, the airline industry perhaps hasn't been run as well as it should have done in the last few years. And to give them money to, we've just talked about the business may be a bit of a failing business model in the future. At least it's going to probably have to retrench. Bailing out a potentially failing company or industry, you have to think of the opportunity cost. And it seems to me, the opportunity cost should be better trying to provide some support for some of the smaller business, maybe more entrepreneurial stuff. The small businesses are the ones who really struggle to access capital. And it feels to me that we're very dangerous because we start to, the government starts to choose who wins and who fails. And that's not how it should be, and we've got to be very careful. And I think after 2008, where people were very upset about what happened with Wall Street versus Main Street, we're basically back there again. And if we're not careful, the vast majority of people, losing their jobs and yet watching an airline company potentially get bailed out and, paying CEOs lots of money doesn't sit very well. And I think, back to our very initial point, it's about generating demand to get the economy back on its feet, and therefore, how's the best way of getting that money to the people who really need it? And that's what we've got to be careful about. So yeah, I'm somewhat concerned.
Stimulate demand. So stimulate demand is the solution, is what you're saying then?
It is. Yeah.
Okay, so that's interesting. I'm going to go slightly off piece for the remaining couple of minutes of our show, in a sense, then, because I want to say something on specifically that, in respect to Cayman, because it seems to me one of the things Cayman's doing very well, and first of all, we should all give a lot of thanks to those who are the responders in this situation and who are doing the hard stuff on the front lines. For the rest of us working from home, life is relatively easy, and we should never forget that. But one thing we do need to plan for is getting the economy back on its feet, and that's, I think, symptomatic of a problem that all politicians around the world are facing. Is they're focusing on the current, which is understandable, but not spending enough time on the future, and that's to the detriment of the economy and also to the detriment of people living in the economy. We need to have a better plan collectively, both in Cayman, in the US, in the UK, and it's something that's not being done fast enough. And so I would suggest that needs to be done a lot quicker. And also, I think one thing that Cayman could perhaps learn from is the point you're making, Adam, about stimulating demand. We need to get people in Cayman who aren't working again. We need to free up the labor market to make it easier for companies to hire, to make it simpler for people to recruit people, whether those people be Caymanian, whether they be non-Caymanian, so that money can get into the economy, so the multiplying effect of that money in the economy can stimulate more jobs for Caymanians and such like. That's something that should be happening right here, right now. And I wish we could see a little bit more of that talked about in sort of press briefings and announcements. And the final thing I'd say, we've got about a minute left in the show, the final thing I'd like to make an opinion on is good intentions don't always equal good policy. And I've got a real beef with one thing here, which is this social distancing and the limiting of hours. One of the things, and I totally understand the intentions, but one of the things we're trying to do is stop people congregating. It's a terrible solution to stopping people to congregate by limiting hours of stores. All you do is you force the same number of people into the same space in a shorter period of time and create queues and create problems like that. We should be liberalizing the hours that stores could work. Let supermarkets open on Sunday, spread people out more, get that sort of dynamism working in an economy, and we'll actually make things better than what we're doing right now all across the world, Cayman included. that's my editorializing done. I've apologized for monopolizing the last 2 minutes on that, Adam, and apologize for having a bit of an opinion on that there. But I just wanted to make that comment from a psychological and a behavioral type of aspect. So as always, we do run out of time before we'd like to. So let me just say thank you to you, Adam, for joining us on this morning and for sharing and imparting your wisdom with us. It's been invaluable and really helpful, and thank you very, very, very much.
Pleasure. Thank you, Simon.
Okay, now to all of our listeners, thank you again for joining us during these unusual and difficult times. If you have any questions about finance, investing, or similar, please do feel free to connect with us, and one of us will do our very, very best to respond. Email us if you wish at moneysense@candw.ky, or connect with us on social media via Twitter with the username @MoneySenseRadio. That's all one word, @MoneySenseRadio. Give us your question, give us your opinion, and if we can, we'll get some time together and we'll give you a reply or we'll address it on the next show. So with that, thank you all once again. Stay safe, goodbye, and please do tune into Money Sense again in 2 weeks' time.